Most people are misreading XRP right now. The biggest story isn't today's price action. It's the quiet transformation of the global financial infrastructure as central banks and major institutions test new ways to move money across borders. That's why investors are watching developments around digital currencies, interoperability, and settlement technology more closely than ever. In the next few minutes, we'll separate documented facts from speculation, examine where XRP fits into the conversation, and explore why this debate has become one of the most closely followed narratives in digital finance. See, the question isn't whether the financial system is changing. It already is. Around the world, central banks are researching digital currencies. The Bank for International Settlements is coordinating cross-border payment experiments. Commercial banks are exploring tokenized deposits. And financing institutions are investing billions into technologies designed to modernize how value moves around the world. Now, this is what most people miss. These developments aren't happening in isolation. They're all trying to solve the same fundamental problem: how to move money with the same speed, efficiency, and interoperability that transformed the internet decades ago. Within that broader transformation, XRP has become one of the most debated technologies in finance. Supporters believe it could play an important role in connecting different payment networks, while critics argue the evidence for widespread institutional adoption remains incomplete. Today, we'll examine what the public evidence actually shows and why this story extends far beyond a single cryptocurrency. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. See, to understand why this discussion matters, we first need to zoom out. See, for decades, international payments have relied on a network built long before smartphones, cloud computing, and blockchain technology ever existed. See, when money travels from one country to another, it often passes through several correspondent banks before reaching its final destination. Each institution performs its own checks, adds costs. Each introduces delays. Settlement may take days instead of seconds. Liquidity becomes trapped across multiple jurisdictions. Counterparty risk increases. See, this model has supported global commerce for generations. But it is also one of the reasons international payments remain expensive and inefficient. The need for modernization isn't controversial. Even institutions like the BIS and the IMF have repeatedly discussed improving cross-border payments through greater interoperability, digital infrastructure, and standardized messaging. That is the problem the industry is trying to solve. Not necessarily replacing every existing system overnight, but upgrading the plumbing beneath global finance. Now, this is what most people miss. When institutions discuss digital money, they're often talking about several completely different things at once. There are cryptocurrencies like Bitcoin. There are programmable blockchain platforms. There are stablecoins issued by private companies. And then there's CBDCs, digital versions of sovereign currencies issued by central banks. These aren't interchangeable. A retail CBDC might allow consumers to hold digital cash directly. A wholesale CBDC could be designed for settlements between financial institutions. Meanwhile, tokenized commercial bank deposits represent another entirely different category. Increasingly, researchers are asking whether all these forms of digital money could interact on shared infrastructure while remaining under their respective regulatory frameworks. Interoperability, not uniformity, has become the recurring theme. Let that sink in. It's very important. See, instead of forcing every country onto one currency, the objective is allowing different forms of money to communicate efficiently. That's a fundamentally different challenge. History offers an interesting parallel. In the 19th century, railways transformed commerce, but their greatest challenge wasn't simply laying tracks. It was standardization. Different regions initially built different rail gauges, preventing trains from traveling seamlessly across networks. Eventually, common standards unlocked dramatically greater efficiency, allowing goods to move across vast distances with far fewer obstacles. Today's financial system faces a similar challenge. Not every country will build the same digital currency. No. Not every bank will use identical technology. No way. But if common standards allow these systems to communicate, the entire network becomes more valuable. That's one reason interoperability has become such an important concept in discussions surrounding digital finance. This brings us to Ripple. Ripple is frequently associated with XRP, but the company and the XRP Ledger are separate entities. Ripple develops enterprise payment solutions and has promoted technologies designed to improve cross-border settlements. The XRP Ledger, meanwhile, is an open-source blockchain maintained by a distributed network of validators. Over the years, Ripple has introduced solutions aimed specifically at central banks exploring digital currencies. Write that down. One example is Ripple's CBDC platform, which is designed to allow governments to issue, manage, and distribute digital currencies using technology inspired by the XRP Ledger architecture. Supporters see this as evidence that Ripple's technology could become increasingly relevant as CBDC adoption accelerates. Skeptics counter that pilot programs do not necessarily translate into national deployment. Both perspectives are worth considering. Pilot projects are important because they demonstrate technical capabilities, but they do not automatically guarantee widespread adoption. No. That distinction matters. But here's where the conversation becomes much more intriguing. As governments begin researching CBDCs, another trend emerged. Financial institutions started discussing tokenization. Instead of moving paper-based financial assets through slow legacy systems, why not represent those assets digitally? Government bonds, treasury bills, commercial bank deposits, real estate, equities, even carbon credits. Everything could, in theory, become programmable digital assets. Tokenization isn't simply about creating digital versions of existing assets. It's about enabling faster settlement, improved transparency, and programmable financial contracts. This version extends far beyond cryptocurrencies. It's about rebuilding financial infrastructure itself. And that broader transformation explains why major institutions have invested so heavily in blockchain research over the past several years. One organization appears repeatedly throughout these discussions: the Bank for International Settlements. Write that down. Often described as the central bank for central banks, the BIS has coordinated numerous innovation projects involving multiple jurisdictions. These initiatives explore questions surrounding interoperability, cross-border settlement, programmable payments, and wholesale digital currencies. Projects such as Manar, Mbridge, Agora, Jura, and others have examined digital aspects of digital financial infrastructure. Some involve tokenized deposits, others investigated foreign exchange settlements, some explore decentralized technologies, others evaluate permission networks. Importantly, these projects involve many technology providers and research partners. Public documentation generally focuses on testing concepts rather than endorsing one specific blockchain as the future global standard. Nevertheless, a growing number of collaborative experiments signals something important. Central banks are no longer asking whether digital finance deserves research. They're actively building prototypes. Now, this is where interpretation enters the pictures, ladies and gentlemen. Within the XRP community, many researchers believe this institutional initiative puts towards a future in which interoperability becomes more valuable than any individual blockchain. They note Ripple's participation in standards discussions. They point to Ripple's CBDC platform. They highlight Ripple's experience with cross-border payments. They also emphasize technologies such as the Interledger protocol, designed to connect different payment networks without requiring every participant to operate on the same ledger. Supporters argue that this architecture resembles the internet itself. Different networks, different operators, different rules, yet all connected through common protocols. Critics respond that numerous interoperability solutions exist, including approaches developed by other blockchain ecosystems and enterprise software providers. The debate continues because the future infrastructure has not yet been finalized. And that's an important point to remember throughout this discussion. Prices may react to speculation, but systems evolve through years of testing, regulation, implementation. Another name frequently mentioned alongside Ripple is R3. R3, developed by Corda, an enterprise distributed ledger platform focused primarily on regulated financial institutions. Its network includes banks, insurers, and other major organizations exploring digital asset applications. Ripple and R3 have had a complicated history, including legal disputes that were eventually resolved through settlement. Most recently, both companies have continued operating within the broader digital asset ecosystem. Supporters sometimes argue that because institutions collaborate across multiple platforms, technologies like Corda, Ripple's payment infrastructure, interoperability protocols, and tokenization initiatives could eventually complicate and complement one another rather than compete directly. That possibility reflects a larger trend across finance. See, the future may not belong to one blockchain, ladies and gentlemen. It may belong to ecosystems capable of connecting many different networks together. That idea brings us to one of the most important concepts in this entire conversation: interoperability. Think about the internet for a moment. No single company owns the internet. Millions of independent networks communicate using standard and shared protocols. Emails have moved between different providers. Websites operate on different servers. Mobile devices connect through different carriers. Yet users experience one interconnected system. This serves as a useful analogy for what many policymakers envision for digital finance. Not necessarily one global ledger, but multiple regulated systems capable of communicating securely and efficiently. Whether the XRP Ledger ultimately becomes one of those connecting layers remains an open question, but the direction of travel is becoming increasingly clear. The future of finance appears to be moving towards greater digitization, greater tokenization, and greater interoperability. And that's setting the stage for a much larger transformation, one involving not just payments, but the very definition of money itself. Because once value can move instantaneously across programmable networks, the implications extend far beyond faster transactions. They reach into capital markets, trade finance, global liquidity, and perhaps even the architecture of the international monetary system itself. And that's why the story becomes even more compelling. See, to understand why so many investors are paying close attention to these developments, we need to look beyond payments, because the conversation is no longer just about sending money from one country to another. It's about reimagining how every financial asset moves. Imagine a future where governments, bonds settle instantaneously instead of days, where commercial bank deposits become programmable, where tokenized securities can be exchanged around the clock, where liquidity moves automatically to wherever it's needed most. That's the broader vision behind tokenization, and it's a vision that institutions across the financial industry are actively researching. The World Economic Forum, major investment banks, financial markets, infrastructure providers, and central banks have all pushed work examining how tokenized assets could reshape capital markets over the coming decades. See, the objective isn't necessarily to replace today's financial system overnight. No, it's to modernize it. Short-term noise, long-term structure. That phrase captures the distinction many long-term investors are trying to make. See, markets often focus on daily price movements. Institutions, by contrast, often spend years building infrastructure before the public ever notices. But here's where it gets interesting. One recurring topic in discussions about future financial infrastructure is liquidity. Today's correspondent banking system requires financial institutions to maintain large pools of capital around the world. Those funds often sit idle, waiting to facilitate international transactions. If settlement becomes significantly faster, institutions may need less pre-funded liquidity. That possibility has attracted interest in a range of technologies designed to improve capital efficiency. Ripple has long promoted XRP as a potential bridge asset capable of facilitating cross-border transfers without requiring institutions to pre-fund accounts in multiple jurisdictions. This is so important, ladies and gentlemen. This is massive. See, supporters believe this could reduce costs and increase settlement speed in certain use cases. However, whether financial institutions choose XRP, tokenized deposits, stablecoins, or other liquidity solutions will depend on regulation, market adoption, and commercial incentives. The technology landscape remains competitive. Now, this is what most people miss, unfortunately. Sometimes people assume that because institutions are experimenting with blockchain technology, they have already selected a single winner. No. Publicly available evidence doesn't support that conclusion. Instead, we see our pilot programs, proofs of concept, technical evaluations, collaborative research. Different jurisdictions are exploring different models based on their own legal frameworks and policy objectives. Some countries emphasize privacy. Others focus on wholesale settlement. Some prioritize domestic payments. Others concentrate on cross-border interoperability. These diversities suggest that the future financial system may consist of many interoperable networks rather than one universal blockchain. That possibility actually strengthens the importance of interoperability itself, because the more diverse the ecosystem becomes, the more valuable connectivity infrastructure may become. History provides another useful lesson. In the late 20th century, the internet didn't emerge because every company agreed to use the same hardware. It expanded because shared communication standards allowed different computers, operating systems, and networks to exchange information reliably. Competition continued, innovation accelerated, yet common protocols allowed the ecosystem to flourish. Many analysts believe digital finance may evolve in a similar way, not through absolute uniformity, but through interoperability. That doesn't tell us which platforms will ultimately dominate, but it does explain why standards have become such a major focus across the financial industry. One standard frequently mentioned in discussion about modern payments is ISO 20022. See, unlike blockchain, ISO 20022 is a messaging standard. It defines how financial information is structured and exchanged between institutions. Many payment networks around the world are migrating toward this standard because richer, more standardized data can improve automation, compliance, and cross-border communication. Ripple has publicly supported ISO 20022 capability within its enterprise offerings, alongside many other financial institutions and infrastructure providers adopting the same messaging framework. Some investors interpret this as another sign that Ripple is positioning itself for greater institutional relevance. Others point out that ISO 20022 is widely adopted across the financial industry and is not exclusive to any one blockchain or payment company. Both observations can be true simultaneously. Adopting common standards doesn't determine who wins. It simply ensures participants can communicate more effectively. But the real shift came when financial institutions stopped asking whether digital assets belong in finance and started asking how regulated digital assets should be integrated. That change in mindset is subtle, but significant. See, the conversation has increasingly moved from should we tokenize assets to how should tokenized assets interact with existing financial infrastructure. That evolution reflects a broader maturation of the industry. Instead of framing blockchain as a replacement for traditional finance, many institutions are exploring how distributed ledger technology can complement existing systems. This hybrid approach appears repeatedly across research papers, innovation projects, and industry discussions. It's about gradual integration rather than sudden disruption. Now let's turn to one of the biggest debates within the XRP community. Some researchers argue that terms like shared ledger, unified ledger, or regulated liability network describe architecture concepts that could be compatible with technology such as the XRP ledger. Others go much further, suggesting these initiatives are effectively describing the same underlying infrastructure. At present, publicly available documentation does not establish that these terms all refer specifically to the XRP ledger. Rather than they describe broader frameworks for connecting tokenized money and assets under regulated environments. That distinction is important. The concept may overlap. The technologies may interoperate. The participants may collaborate. But architectural similarities alone do not confirm that different initiatives are built on the same blockchain. See, for investors, understanding that difference helps separate confirmed developments from emerging narratives. Another historical comparison helps put this into perspective. During the Industrial Revolution, thousands of factories adopted steam power, yet no single manufacturer supplied every engine. Different companies built different machines. What transformed the industry wasn't one specific engine. It was the widespread adoption of the underlying technology. Digital finance may follow a comparable path. Success may depend less on one platform replacing every other platform, and more on the overall transition towards programmable, interoperable financial infrastructure. If that's the case, multiple technologies could play meaningful roles. So where does that leave XRP, the anointed one? The answer depends on which question you're answering. If the question is whether Ripple has positioned itself within institutional conversations about cross-border payments, CBDCs, and tokenization, the answer is clearly yes. Ripple has worked with financial institutions around the world, introduced CBDC-focused technology, and continued expanding enterprise payment solutions. If the question is whether central banks have publicly declared that XRP Ledger should be the global foundation for all sovereign digital currencies, the publicly available evidence does not support that conclusion. Instead, what we see is a rapidly evolving landscape where many institutions are experimenting with multiple technologies simultaneously. Let this sink in. This is very important. This is the most important part of this. That's why investors continue watching developments so closely, because infrastructure transitions often unfold gradually. And by the time they're obvious, much of the foundational work has already been completed. This is ultimately what makes XRP story so compelling. It's not simply about a cryptocurrency. It's about a broader conversation surrounding the future architecture of global finance. How should money move? How should assets settle? How should liquidity follow and flow? How should different financial systems communicate across borders while representing national sovereignty and respecting them? Those questions are driving billions of dollars in research and investment. The answers are still evolving, and the institutions shaping those answers include central banks, commercial banks, regulators, technology firms, payment companies, and international organizations working together in ways rarely seen before. Prices reacting, systems evolving. That's a distinction worth remembering. Markets often move on expectations. Infrastructures move on implication. See, whether XRP ultimately becomes one of the major components of tomorrow's financial system or whether that future is shared among several interoperable technology remains to be seen. But one thing is becoming increasingly difficult to ignore. The digitization of money is no longer a theoretical discussion. Tokenization is accelerating. Cross-border payment modernization continues. Central banks are actively researching digital currencies. Financial institutions are experimenting with new settlement models. Interoperability has emerged as one of the defining themes of the next generation of financial infrastructure. See, the coming years won't simply determine which technology succeeds. They may redefine how value moves across the global economy. And if history has taught us anything, it's that the biggest technology transformations often appear gradual while they're happening. Only in hindsight do they look inevitable. So perhaps the most important takeaway isn't trying to predict a single winner today. No, it's understanding the structural challenges and changes taking place beneath the surface. Because while headlines focus on daily volatility, the world's financial infrastructure is quietly evolving. And for investors willing to study the macro trends rather than just the market cycles, that evolution may prove to be one of the most defining economic stories of the 21st century. Ladies and gentlemen, if you've enjoyed this deep dive, make sure to subscribe to the channel. Turn on notifications so you don't miss future documentaries exploring the intersection of macroeconomics, digital assets, central banking, and the technology shaping the future of global finance. And if there's another topic you'd like us to investigate, let us know in the comments. Thank you for watching. We'll see you in the next one. Happy Friday, everyone. I hope everyone's having a blessed day. A lot to go over right now. With the BOJ making their move, that always makes things extremely spicy and interesting. I want to welcome all the new members of the Patreon, all the new members of the membership channel. As always, remember, ladies and gentlemen, one solid tip from the pits can easily pay for your entire subscription. If you want the deeper macro research and you want to learn how to take advantage of everything we go over, come and join over 630 active traders and investors inside the Patreon, the Crypto Public Desk Monthly. What I want to just talk about right here is now some ranges, and then we'll get into the broader base. The BOJ always intervenes, and it's been in my experience, when the market is weak or been weakened, the narrative's been weakened. Right now, if you're looking at gold is stuck in the middle. The ranges to look at are 41.36. If it gets above that, it could be off to the races. Or if it gets below 39.96, look out below. Ladies and gentlemen, something is going to happen probably over the weekends, we think. None of this is financial advice, just my own opinion, because bigger moves happen when the markets are closed for some reason. That's just what happens. The other ranges also we're looking at was silver. If silver gets above 60.41, look out. If it gets below 55.89, look out, because these are the ranges. See, most investors waste time consuming information. Very few people spend time analyzing information. That's the difference that determines performance. Understanding where institutional capital is flowing provides insight into what professional investors believe will matter over the next several quarters, not just days. We were waiting for the BOJ to do this. We follow what they do because they like to do that when they get the maximum effect for intervening. It has been like this always in my career, and I was taught this very early on. The markets were pushed one direction. They don't have to do as much work for the powder they're going to expend to do this. That's very important. See, if you focus on positioning, flows, probabilities, and structural themes instead of headlines, you stop reacting to markets and you understand what's going to move them and why. And in investing, understanding almost everything always arrives before opportunity becomes obvious. People think it's easy after it's moved. But if you understand these shifts before they become consensus, it can dramatically improve portfolio construction, risk management, and long-term capital allocation. Ladies and gentlemen, investors who consistently outperform are rarely the ones reacting to headlines. No. They're usually the ones who identify structural trends while everyone else is still debating short-term noise. People who understand those dynamics before the crowd usually don't need to chase opportunities. They're already positioned when everyone else finally notices. And the ones who position early, not randomly, but intentionally, win. And I'm going to say this. You have Tether getting Sharia certification now. The world is changing right now. We see it every day. And as it changes, the narratives become clear of how to play these scenarios. Ladies and gentlemen, if you want to learn to trade, if you want to learn to invest, if you want to learn to take advantage of all the volatility that's being created, and you want to enjoy the returns that our members are seeing inside the Crypto Public Desk Monthly, come and join us. One tip pays for your entire year subscription. There's over 630 active traders and investors learning everything how to take advantage of the volatility. See, the volatility allows long-term accumulation for depressed assets. It allows funds to do this, banks. Why should they be the only ones who get to prosper from the chaos? They're taking advantage of every structural headline that shifts everything. But look, when the BOJ intervened, the dollar, King Daddy-O dollar, DXY took it on the chin, everything else changed. When you learn the playbooks that the big banks and hedge funds use, it's not so complicated anymore to understand why they're doing what they're doing. There'll be an escalation in this situation because that's what's coming. You have violence in 3 regions now. So as far as we're concerned, when the markets are thin, big players do things to move it because they get the most bang for their bucks. But as the world turns, are you taking advantage of this? To me, we're still in the camp that the Clarity Act gets done. I'm not going to waver from what I think one way or another. It will get passed. That's my opinion. But right now, when you're in the middle of the ranges, you're committed. You got to understand one way or another what's going to happen so you don't get cut up like sushi. Being financial mercenaries, we take advantage of what happens and why. That's it. You're not beholden to one investment class whatsoever, one asset class. You're looking at futures, you're looking at equities, you're looking at crypto, you're looking at everything, because your bank account doesn't care or trading account doesn't care what trade you use to win, whether you're long or short. But again, this opportunity allowed our members inside the Cryptoholics S Monthly to make between 50 and 150% return on their money, depending on what tips from the pits they took when there was violence, and this went kinetic, and it's flaring up again. So if you want to see how this is done, come and join the Cryptoholics S Monthly. I love you all, ladies and gentlemen. I'll see you on the front lines. This video is for education, entertainment purposes only. This is not financial advice. Always consult a licensed financial advisor before making any investment decision, always. Never invest any capital ever from watching a YouTube video. Never base your investment decisions from watching a YouTube video ever. These entertainment videos I love, but that's what they're for. They're for entertainment. But I believe that the seesaw is going to continue, and I believe that we have it dialed in. And if you want to see how we're doing this, come and join us. I love you all, ladies and gentlemen. Have a blessed evening. I'll see you on the front lines.